All right, guys, welcome to today's first bi-weekly forecast for the foreign exchange market. We're not only going to be looking at foreign exchange market, I guess, currency pairs or just financial assets, but we'll be looking at commodities depending on what you guys want to see. Now, I ran a poll on the Telegram and you guys picked 3 pairs that you predominantly want to see forecasted during these programs. So today I've picked the 3 most common ones that you guys wanted to see, which was EURUSD, GBPUSD and gold, which will now be displayed to you on this screen. So within these programs, what we're going to do is we're going to look at these pairs to see, in reference to whether they're hot or not. So now when I say hot or not, I'm talking about the current cycle sequences and if there's any opportunities that anyone or everyone can capitalize on. So first off, we're going to start off with the monthly trend. The monthly trend on EURUSD, which we're going to begin with, is still corrective. We use the Dow theory and the Dow's 3 movements to identify the current trend in motion, whether we are in a primary movement or secondary movement, which is key to identifying the current market cycle. Nevertheless, what we can see here is we can see a trend that has spanned nearly 11 years to the downside. Now, this doesn't mean that the fluctuations of the market cannot counteract the current primary trend, meaning this doesn't mean price can't move higher at any given point in time. What the Dow theory implicates and states that a significant area of market structure needs to be broken to identify and confirm a new trend. Therefore, we remain bearish until the trend structure is broken and then we can change our bias to a bullish bias. Therefore, whilst the bearish bias remains, we must stick to this current market structure and trade in the current direction of the primary movement until market structure is broken. How I like to use the Dow theory is in conclusion to the Elliott wave theory. So I'll use the Elliott wave market cycles and the Dow theory to form a nice longer term conclusion. In this case, it's fairly simple to identify that the market is still bearish, and in my belief there is still some bearish downside to go when it comes to the wave theory. Now, a key factor here is identifying the market sequence at hand. We can make a case for this to be a triangle. Most definitely, we can make a case for it. So when we're identifying this triangle, we're talking about an Elliott wave triangle. An Elliott wave triangle consists of 5 waves, of course, so once identifiable, we know that it separates wave A and C as the counter trend movement, almost a sideways consolidation. We can class this as the first cycle sequence. Next, what we can expect is the second cycle sequence to occur. Nevertheless, what we're looking for here is primarily just another strong move to the downside. But however, until a cycle sequence is complete, we cannot interpret this yet. Therefore, we now label this WXY in cycle mode. What we want to do primarily is break this down. When it comes to identifying turning points in the market, we want to be looking at key support and resistance levels. To do this, we have options. We can use horizontal rays on TradingView. We can even use dynamic support and resistance using the parallel channel, or we can just use the simple trend line. Now, how I label up my charts in identifying where the market could be going is fairly simple. I do take into consideration current economic conditions. As of now, we're in a financial crisis. In previous financial crises, the dollar has strengthened. So we must take this into consideration for the direction of the market. Usually there's a surge in demand for the dollar when there is financial implications plaguing the market. And we have to remember this. As long as we can remember this and incorporate this in our trading, we know exactly what we can do and we know exactly how we can capitalize on any further market movements. So this is the key factor, guys. Now we can break it down. We can now break it down and go into the weekly time frame. Before we do that, we need to make sure that we can see all the key variables and details on multiple charts. Perfect. So we're working our way down from the monthly to the weekly. We call this top-down analysis. So first of all, using the wave principle is about identifying patterns. What I see here is the first wave or first corrective wave of a pattern. Now, this can simply just be flat, and we could be forming the next wave B with C meeting the previous wave A. So we know our nominal low is wave W. So putting all of this into perspective, we know that any breach of wave W would indicate a sideways correction. And in this instance, we have seen a breach within this first corrective pattern. We just want to know, and we need to find out what corrective pattern is going to form here, if we're going to see a wave B correction, or if we're simply just going to see a further sideways or maybe a triangle before we move to the downside. There's all these variable opportunities and conclusions that we can make from here. Nevertheless, the key point here is that we must incorporate top-down analysis on each pair. We're not going to do this for every pair. However, it's important that we break it down for at least one, so we know exactly what we're doing, and we know that the movement or the primary movement is to the downside. Ideally now, we have a larger channel and we have an even larger channel. So now we have a comfortable channel. You can see price has retested this channel already. So again, this channel is proving to be strong. So considering that this may even just be a B wave forming, we can make a case for further downside and for price to meet previous support. So we must keep this in mind. Now, without having to do much wave analysis, we can see how price has tested this channel and produced a bearish reaction on the Friday. So again, look, you can see price has been choppy, but it has been trending to the downside. Despite a surge in volume upon hitting the highs of nearly 1.15, we have seen a surge in volume also to the downside, which was more monumental in comparison to the upside. So this gives us our bearish structure, and this is what currently remains. Now what we're looking at is fairly simple. We are expecting price to continue falling. Price has hit previous resistance. It also depends on how you want to see this resistance. What we look at is key psychological levels. Has price hit a key psychological level? I think so. And it's seen a lot of supply and demand around this level. Nevertheless, we can make a case for price to move to the downside. Ideally, we want to see a nice bearish daily closure, hopefully an evening star to confirm further downside, and that would be our entry signal to short this market. Using these variables, we know exactly how we need to play EUR/USD, remain bearish, and profits will come. Usually after these kind of parabolic moves higher without any bearish daily closes, we can always expect a retracement. This doesn't mean we're going to see another replication of this crash in March, but it does mean we will see surges and downside pressure, at least in a corrective instance. What we can now do when we look at price action, we can see how price did produce a pin bar here, and we are now in a phase where we could see price potentially sell off. What I see this under the wave principle is a triangle. This triangle separates both waves, intermediate waves, and gives us structure. We also have a potential channel. Again, if we see a break of this channel, of course, we can expect price to move towards the lows. This is what I broke down in the pre-market breakdown for the members. Of course, I'm breaking it down for you guys as well to give you guys an insight of what you can expect and how you can play the market in your own perspective and your own hands. Now, let's move on to GBP USD. Again, I've applied the wave principle to GBP USD. It's fairly simple, but it can be complicated depending on the sequence of trend. What we have here is simply an ABC pattern. Now, it's more complicated than the normal ABC pattern that you would see. This is because we featured a truncation and we are in a complex corrective sequence. So putting all of these factors into perspective, we kind of have to take a patient approach here. And we kind of have to be flexible and open-minded with what the market can develop and produce. Nevertheless, what my primary bias is on GBP/USD is further strides higher to complete another complex correction. Again, we have a bearish channel. So to see a break of this high would of course change the structure, but there's multiple structures we would also need to break in order to consider a nice bullish move to the upside, which would of course significantly mean that the dollar would sell off instead, and this would invalidate our EUR/USD analysis. So under the wave principle, there is a lot more flexibility here. Moving down to the weekly time frame, again, we've seen a nice sell-off and we are in a recovery period. May we see a retracement here? Of course, we can definitely make a case for retracement. However, the key part here is last week's weekly candle did close above the 618. So this isn't a good sign of a retracement. Ideally, what we want to see is we want to see price close below the 618 for in a retracement stance to make a case for this. Because this didn't happen, again, this kind of invalidates any bearish kind of scenario, which is why I remain bullish and which is why 155 still remains a reality here. Again, breaking it down even more, what we have here is a first wave cycle sequence. Now, since this is a C wave, an intermediate C wave, of course, this corrective sequence could take a while to formulate before we actually see any prior wave 3 impulse. So what we have to do here is be patient with our approach. Could we make a case here for a wave 3 impulse in motion? Of course we could, most definitely. However, we would have to go into lower time frames to actually identify a wave 3 impulse and then trade accordingly. But again, we're traders. We want to make sure we're capitalizing on the long side and the short side and not just one side of the market. So primarily what we want to see is a breach of previous resistance levels. So until GBP/USD breaks 127.256, we can't make a case for any further long. So if this price does hold, again, we can remain bearish and expect price to meet previous lows. So this is my bias and how you can see the market. Of course, we don't even have to look at the wave principle here. This is how you can just see the market without having to apply the wave principle and just Fibonacci and basic analysis. Again, even if you want to, you can draw a trend line and look for further confirmations, a break of structure. Again, fairly simple, guys. Not too complicated. Last but not least, we have gold. Now, gold is the most primarily traded commodity in the entire world. When people look at gold, people just look at the gold dollar value. They don't look at the GBP value or the euro value or the yen or the AUD, even though the AUD has a high correlation with gold. They look at the dollar value because that's the international gold price, considering the fact that the dollar is the world's reserve currency. It makes complete sense. Now, what we need to do, first of all, is identify what sequence of trend is gold in. Now, a lot of people, they fail to look. Some people do. But what we want to do always when we're analyzing gold is look on the monthly time frame, because the monthly time frame is going to give us a good indication of what we can expect with gold. Primarily, we can see that gold is retracing at the moment. This current monthly candle is retracing, and we're nearing the 886 Fibonacci level. However, since 1999, we have been in a strong uptrend. So this is what we call a primary 5-wave impulse. What we have seen after is price enter correction. Now we know this is an impulse because look at the breadth of the previous impulse and compare it to the current breadth of this uptrend. It's not similar, and price and time does not meet. So putting this into perspective, we can make a case for a corrective stance. We know the market high is here, and this is our key reference point. A break of this high would of course mean that we are either going to see the start of a new uptrend, or we're going to see a sideways correction and a possible crash in a possible flat. Of course, again, this is a market that is very flexible. There's a lot happening. There's a lot of volume in this market, so we have to be attentive to what could happen here. So putting all of this into perspective, gold is a very key market to look at. Now, what I have here is fairly simple. Gold and the wave principle goes hand in hand. Why? Because it prints and outlines the wave principle, public participation and market sentiment all in one, as clear as possible, as one of the most traded markets in the world, along with EURUSD. Again, look at how the patterns outline itself with a wave 1, a wave 2 double free correction, a wave 3 impulse, a wave 4 sideways correction in the triangle, and a wave 5 ending diagonal. Again, now looking at this, we have a nice double zigzag with wave W, X, and wave Y here, with price ending and nearly terminating near the prior end of the channel. Now we can make a case that this current correction has ended. However, what we ideally want to see is a retracement towards the 886. This isn't a rule. This is just a characteristic that commonly happens. The correction could have well enough ended by now, so we could see the end of wave B already. However, we want to see further confirmation. Ideally, we want to see either a 5-wave impulse develop here, or we want to see a leading diagonal. Either way, this will confirm to us that we're going to see downside. Also, we want to see a break of structure. Now, we move on to the daily time frame, and when I say a break of structure, I'm talking about a break of structure. This is a break of structure. So a break of structure is previous resistance. You can see how this support level has turned resistance. We want to see a break of this structure and this support level to confirm lower prices. Does this mean we're going to see a straight drop to previous support levels? No, it does not. Because the ebb and flow of the market characterizes and takes into consideration both forces, which is the bears and the bulls. This means that price is not only just going to move down, but it's going to move up as well. So we have to take into consideration all of these factors. As soon as we do this, we know exactly what we can do. Again, we take a patient approach and wait for the market to do what it needs to do. And until then, we stay put. So putting all of this into perspective, guys, gold is a very, very confident and I guess lenient market to look at and to trade and to, I guess, watch as well. I'm sticking to my bias of 1800 because of the confluence levels between the 886 and because of Fibonacci equality between wave W, X with a terminated level of wave Y around 1784. Again, Gold, we could see another sharp move higher, which is what I'm expecting. However, we need to be attentive to a break of 1680. If we do see a break of 1680, prepare for a meltdown. If we don't, prepare for upside. And that's the way we trade the market. Going down to the 4-hour time frame, fairly simple. We can see the sharp reaction from 1680 and how this level has held. So what we want to see is either further confirmation higher, or we want to see a break and retest before we trade to previous support levels. Simple as that, guys. I hope this video was helpful. I really do hope it was helpful. More videos like this will be coming soon. I will be making sure to keep you guys updated, especially with the weekly breakdown. And this bi-weekly forecast will be done every single week, every Monday morning, GMT. Thanks for watching, guys. I hope you enjoyed it. If you're watching this on YouTube, make sure to subscribe, make sure to comment, and I will be delivering more content. That's all for now, guys. Take care, and I'll see you on the next bi-weekly forecast.